In this video, I'll show you the strategy that I use to make actually way more than 10x in my portfolio. But what happened in the past isn't that important, is it? We need to look forward and figure out over the next 5, 10, 15 years, what is going to be the strategy that makes us another 10x. And so having been in markets now for over 15 years, before crypto, I was in the stock market, I've realized it's basically one trade. It's one thing that we need to focus on, which I'll repeat throughout this video, which is short the fiat currency, go long the assets, and compound over time. That is the way to make very, very good investment returns reliably, and importantly, at the end of it, actually have assets that you own that are desirable and that you can rely on at that point. Because making quick 10x's in small things and altcoins or whatever else, it's unreliable and it's not a solid base to build a foundation off of. After all of the research I've done, it's building a base of very strong desirable assets that get stronger over time and compound your gains over time. And so in 10 years, 15 years, you're gonna have a basket of very strong assets that you can then rely on. We don't wanna be making very quick returns. It's very schizophrenic and it's unreliable and it's not a good place to be. So I'm gonna show you all of that in this video. Firstly, I'll show you the asset classes that we can invest in. And then from there, all you have to figure out is how long it's going to take you to make a 2, 5, 7, 10x. Now from here, of course, some timing is involved as well, and I'll get to that later on in the video. But the bulk of our investments should simply be to get rid of fiat currency and invest in assets. Notice that all of these return profiles here, this is the dollar return that we're looking at. So all of these assets and asset classes valued in USD. USD is the world reserve currency. It is the best fiat currency out of the lot, meaning that it essentially debases itself less than the others. Now, all fiat currency must debase because fiat currency is not money. It's not an asset. Fiat currency is debt. Fiat currency is created as debt. And debt, when you take it out, is usually placed upon assets that collateralize the debt, like homes or businesses, etc. And sometimes there's unsecured debt that is created as well, but that has to be paid off. Now, the very simple thing that I've realized here with fiat currency is that because fiat currency is debt, it must continually be created to pay off previous debt, right? If a bank loans $1 billion into existence with a 10% interest, there's only $1 billion of currency in circulation. But the clients of the bank need to pay back that billion plus 10% interest. Where does the 10% of those currency units come from? Where does the 10% extra come from? It must be created by the same bank or another bank. Therefore, that currency just debases again and again. And remember, currency is created when the bank creates debt, which means that debt has an interest on it. So the debt can never, ever, ever be paid back. It must continually be created. And when there is a currency crisis, which is when debt actually slows down, the central bank steps in and literally prints the currency units out of thin air, increasing the currency units. The fiat currency system must have inflation. And that is why prices always go up. What we have to figure out is what is the actual rate of currency debasement as a base. And then on top of that is the actual return that assets give you. I'll show you this data. In any case, we need to look at assets. So we'll go over to this. This is global M2. It's not a perfect metric, but it shows in general the amount of currency, fiat currency supply around the world at central banks and in other banks, commercial banks. So you can see just very clearly that the amount of currency units, fiat currency units in circulation goes up. Yeah, there's some ups and downs or whatever, but the fundamental principle is that fiat currency must increase in the amount over time. It absolutely must. Otherwise, the whole entire system will collapse because there aren't enough currency units to pay off the debt that exists. And so you must have banks that constantly create this stuff and the government making sure that they do, and if not, the central bank steps in and literally prints the currency units out of thin air. This is the basis for which assets go up in price, because if there's the same amount of asset that remains the same amount of desirability, and you have the currency that is increasing in amount, then that asset looks like it's going up in price versus a fiat currency. And so you have to approach the market like this. What are you measuring against? We are measuring assets versus the fiat currency. And that may not be the best way to actually measure assets overall. Yes, it's a very easy way to actually figure out the relative return of these all, but you may actually want to measure your returns versus another asset. So your asset versus the other asset. That's actually a good way. That actually is a way that we can figure out our purchasing power over time of desirable things. So I personally don't want to look at assets versus the dollar. It's a good short-term measure, but over time, I want to look at what assets do I own and how much can they buy of the things that I actually need over time, like healthcare and education and food and shelter. They're the important things. I don't want more fiat currency. Yes, it can buy me those things in the short term, but as an investor, you need to look at what assets am I buying, what's the mix here, and how can that outperform the cost of goods and services that I desire over time. So let's look at this as an example. We basically have a few different asset classes. You have cash and money instruments. They usually do not return basically anything. So you can see the annualized figures from 2011 to 2025. Down here, cash and money market instruments, basically 1 to 2%. Now, I think the actual debasement rate of dollars is around 7 to 10% a year. I'll show you some data here. So 7 to 10% a year is the hurdle rate that I need to beat. Now, if you're making 2% in your assets and the currency is debasing by 10%, you're still losing purchasing power by buying those assets. As we move up, you have certain types of bonds that may be a little bit higher paying. You can see around 3.5% here. Now we move up to gold, which over the last decade is around 4.5% a year. Now, if the currency is debasing at 7 to 10% a year, then gold isn't really keeping up with the amount of currency debasement. And so you're still losing purchasing power versus other things. As we move up, we get into some more exotic securities like convertible bonds. You can see real estate investment trusts here. So real estate in the US is annualizing at around 7%. So keeping up with money supply debasement more or less. And then convertible bonds a little bit high here, maybe about 9%. As we move up, we move into equities. Typically a very, very good store of value over time, a little bit more volatile, but really the basis of most of the returns that people get in their investment and retirement portfolios. So US large caps here, around 11%. And then you have the NASDAQ, which is focused on technology, which really drives most of the productivity gains in society. So you would obviously assume that that would have a higher return, and it does. It's more concentrated as an index. You have 100 companies here versus the S&P 500, SPY, which is 500 companies. The more you diversify, you maybe protect from some downside, but you also clip off any outsized returns as well. For the NASDAQ 100 top companies in that index, non-finance companies. There's mostly tech companies in here, but some others. You're looking at about an 18% return. And then Bitcoin as a new asset class, around 150% return. The real annualized rate for Bitcoin right now, somewhere around 30 to 40% a year. So those are the asset classes. And with more volatility, you also get outsized returns as long as the asset is fundamentally growing over time. So you have to figure out where you come on this. If you want to hold cash and bonds, that's fine. It's very, very low risk, but you are losing money over time. So is it low risk? Well, we don't mix up risk and volatility. Risk is the risk of loss of your capital and purchasing power. Volatility is the risk that the price goes up and down. Well, you have very low volatility in bonds, but you also will 100% lose purchasing power. I think that's pretty risky, personally. Now, if you go up to equities, they're more risky. They can go down 20, 25% pretty easily in a couple of months. But over time, they actually return over and above the currency debasement rate, which means you're gaining purchasing power. So I think the actual risk here is less, even though the volatility is higher. Bitcoin, if you like it or not, 150% a year, annualizing at 40% a year now, extremely volatile, but it has made excess returns. And so if you've been in it for a long time, a lot of the volatility doesn't matter to you anymore because you've made big gains. And that is actually increasing your purchasing power versus all of these desirable assets, right? So Bitcoin has increased Bitcoin holders' purchasing power versus all of these other assets, which means they have actually gained wealth versus the holders of these other assets. I want to show you two slides here that drive this point home. It's extremely important to understand the premise of what investing is, which is shorting the fiat currency, going long desirable assets, and compounding that over time. It's the most reliable way to actually make your life better. This is currency debasement. In the US, the M2 money supply rose by 30 billion in the previous month, etc. Look at this since the 1960s. So let's assume that the fiat currency money supply increases. And that means that when you have more currency units valuing the same amount of assets, those assets go up when valued in those currency units. Simple curve, right? Same amount of assets, more currency units. More currency units means they're going down in value per unit in their purchasing power versus those assets. It's as simple as that. Look at this slide, and I want to focus on the credit currency unit supply growth. So US M2 money supply year over year, you can see here that the long-term average is around 6.89%. So 7 to 10%, I think, is the currency debasement rate. You can see that it goes in waves for sure. So in green here, this is the year-over-year change. Sometimes it's positive, it does go negative for occasions, positive most of the time, negative here, positive, negative. So it goes in waves, and that creates price fluctuations in the assets, which are an opportunity for us as well, because if prices come down for those assets, then that's an opportunity to buy them. And over time, the M2 money supply growth and credit currency unit supply growth is going to push those assets higher. So there's two opportunities here. The first one is, over time, assets will keep their purchasing power versus the credit currency units we call dollars or pounds or euros. So they'll go up. The other opportunity is that the amount of currency supply growth fluctuates. And when we know that, we can take advantage when the credit currency unit supply growth falls and prices of assets actually come down, because we value them in the fiat currency. So you have assets valued in dollars. Dollars go up a lot in supply. That means the asset prices rise and the dollar falls in value. But if the dollar actually strengthens and the rate of change of unit supply growth falls, then those assets are going to have to rebalance a little bit and maybe not come down in price. They could either come down in price or go up slower versus the credit currency units. We play this game where we value all assets in credit currency units called US dollars. And this is the opportunity because it will not change. As long as we understand this, we can play this game and play this system to our advantage, where most people don't get this and don't understand it. So we can play to our advantage and actually make investment returns. So the main thing, credit currency unit supply grows at about 7% a year. That's the opportunity. The other one is it changes and fluctuates in its rate of growth, which is also an opportunity because, as you can see here, this is M2 supply growth in blue, and it changes, and assets actually price this in as well and change around. So as long as we know this, when we get dips in M2 supply growth, we can be aggressive going in. That's usually great opportunities to buy assets when they're typically fairly low in price, in bear markets or anything else, in relation to the trend, which must continue, that credit currency unit supply will grow over time. The key to making big returns is to buy the best assets over time and keep compounding your investment in them. And the portfolio grows bigger over time. So it's not about trying to find the diamond in the rough, because by the time you've found it, you've had so many losses that you just can't make back those returns. And one asset does really well, the others don't, and it pulls down all of your returns. Look, just buy an index. Then you're getting the best assets, you're getting some mediocre assets. Bitcoin is actually an index. It's a financial index because it acts as money. So everyone that uses it saves and spends in it. And so it acts as a financial index to those people, right? And it's a desirable asset that is growing over time. So if you take away the actual price chart of Bitcoin, this one here, and then just look at the 200-week moving average. If you're on TradingView, TradingView is free, so I'll link it below. You can go and use it. Go to indicators, type in moving average, this one here, and then the settings here, simple moving average, inputs is 200 weeks. So the time frame is 1 week, length is 200. That is what a long-term Bitcoin investor's portfolio looks like. It's outperformance over time. It's not that volatile, is it? Because it just has outperformance, and the way that you reduce volatility is by consistently averaging in over time. That's your portfolio. But you can do this for many other assets. This is the S&P. You can put the moving average on here, right? Now remember that this is not the return of the index. This is the return of the index valued in dollars. But if the dollar debases at 7 to 10% a year and the S&P is going up at 12%, then you're looking at maybe 3 to 4% returns, right? Real returns in purchasing power. Now for the NASDAQ as well, it's the same. This is the same chart, right? So it's the same thing where you have assets that outperform the fiat currency. Valued in the fiat currency, this is it. If I go back to the Bitcoin chart and I turn back the price chart right here, and what I'm going to do is actually compare Bitcoin USD versus the S&P. So this is the S&P index right here, and we'll put Bitcoin like this, and then we'll compare them. Now what you should see is that Bitcoin, now valued in the S&P, is still going up. So you're gaining purchasing power by buying Bitcoin over the S&P. If you invert the scale, what we're seeing is that the S&P is actually falling in value versus BTC. So BTC is buying way more of the S&P 500 over time. It's got outperformance, right? So what do you want to buy, and what is your purchasing power over time? If you value everything in fiat currency, everything goes up because that's debasing. But if you want to outperform, you have to buy outperforming assets that are strong, reliable, you think will still be around in a decade, and that you can dollar cost average into. It's not trying to find this one thing. You're going to lose because it's too risky. You have to go into strong, desirable assets, and they only come around once in a while. Bitcoin is a once in a lifetime thing where it's monetizing right now, and in the future it'll be very boring and not have outsized returns again. But we have to figure out what is the blend of assets that we want. Maybe 100% Bitcoin isn't for you, I get it. So go S&P, NASDAQ, Bitcoin, and your house. They're the four things. Your house, S&P, NASDAQ, and Bitcoin. They're the things. And you have to figure out what is your mix of those that you're comfortable with. And you can handle big volatility in the riskier things or the more volatile things, and lower volatility in the lower volatility things, but less outsized returns. So you can get that mix. But these are the only four investable assets: your house, Bitcoin, S&P, and NASDAQ, in my opinion. Bitcoin's annualized rate of return is around 30 to 40% right now. It does fluctuate. So I went to Grok and I asked it, if my investment makes 25% a year, so I've brought it down to 25%. Maybe I've got a mix of Bitcoin and the S&P and the NASDAQ. The NASDAQ goes up 18% a year, as you saw. So it's not far off 25%. If I compound at 25% annualized rate of return, that doesn't mean that it goes up perfectly 25% a year. It just means that over an investment time frame, so 12 years, the annualized return, all equal, when you've had some up years and some down years, but you've dollar cost average into it, over that, the CAGR, the compound annual growth rate, or the annualized rate of return, ARR, let's say it's 25%. After 12 years, what would my investment compound into? And the final answer was a 14.55x return. You make 14 to 15 times your money by getting into something with a 25% annualized return. I know it's not glamorous. We want this 10x in 2 weeks. But if you did that, what are you going to do with that money then? You can't invest a large amount of money in that anyway, because it's way too risky. If something is that volatile to go up 10x in a matter of weeks, it's too volatile to put all of your money in and actually invest in it. And so what are you going to do? A little bit of money, and then you make the 10x, and then you chase more and more, and you lose and lose and lose. So you have to find actual, reliable, safe assets that have this growth that compound over time. That is the sweet spot for investing. You can see this as well. If you don't think it's enough, if you annualize 20% returns, you have 100,000 compounded yearly at 20%. Over 30 years, it's $26 million. Even if you have $1,000 only, in 30 years, that's $240,000 compounded. It is in the mid to latter stages that you make the most money. Look at Warren Buffett. He made the vast majority of his wealth in the last decade, 15 years, because he just compounded and held the assets. As they grow larger and larger and larger, the nominal amount that you're making becomes much more important as well. And so if you're in your 20s or 30s watching this, you probably are. Do you have another 20 years or 30 years? Yes, I hope so. So by that time, do you want to retire a literal multi-millionaire? Start acting now and getting into strong, desirable assets that compound at decent rates over time. You can literally smash buy desirable assets that go up 20-25% a year. After 12 years, you'll have a 10 to 15x. That's the best I can give you. And not all assets have this outperformance over time. Bitcoin is just in a sweet spot where this is a large asset, desirable, and it's growing at these excess rates. So this is a sweet spot trade, as I call it. But I'll show you another example. We want to short the fiat currency, go long the asset. People that take mortgages are carrying out this trading strategy. This is why we think people that own property are wealthy, because they short the fiat currency, they take a mortgage. A 30-year mortgage is going short the fiat currency for 30 years of their entire income for that period, and they go and buy the asset. Property goes up 7% a year. I just showed you at the start of this video. Currency debasement is 7% a year, which I showed you at the start of this video. So property doesn't outperform the currency debasement rate, but it does keep up with it. And so if you're taking a massive 30-year short on the fiat currency to go long the asset, then it looks like you're wealthier. And you actually gain purchasing power versus people that don't have the houses and haven't taken the debt. So that's how you outperform them, and it looks like you're wealthier. But I just showed you the S&P valued in Bitcoin is down. Real estate, down. NASDAQ index, down, because this has outperformance. Choose what mix of that you want. The game is to short fiat, go long the asset. You can see here that this is global M2, right? So the amount of money supply around the world versus an asset that is fixed in supply with slight inflation rate, which is coming down. As we have an expansion in money supply, Bitcoin goes up. Don't call it Bitcoin, call it the asset. Look at housing, look at the stock market, anything else. As the money supply grows, the asset grows in price. As money supply contracts, the asset comes down in a bear market. As money supply grows, you have a bull market. As money supply contracts, you have a bear market. And we have an expansion here and another bull market. It's as simple as that. Prices never ever go down because the currency always debases. The credit currency unit system must have inflation and extra units printed all the time. This is consumer price index, the rise in prices of consumer products. It never is allowed to go down ever. This is the game. Short the fiat currency, go long the asset. And you can blend assets. NASDAQ, S&P, Bitcoin, and your house, whatever you want, you're going to make returns and you're going to preserve your purchasing power. If you want to gain it, you have to go into the more volatile stuff and be confident that they're going to be reliable and actually be around in 10 years' time so that you can make those returns. This is the only strategy in the market. It's the only thing. This is what Strategy are doing, formerly MicroStrategy. They are selling essentially debt and convertible bonds, which basically are a form of equity. They are securitizing Bitcoin. People want Bitcoin in the TradFi space, but they can't buy it because of regulations and everything, but they can buy securities in the stock market. That's what Strategy are doing. These people are taking their fiat currency, they're putting it into Bitcoin, essentially. Strategy is a company that says, give us your money, we'll buy Bitcoin with it. Short the fiat currency, long the asset. Now, Strategy are leveraging their balance sheet as well. So the stock is around 2x exposed to the Bitcoin price, very volatile. They're one of the best performing stocks in the stock market. All they do is short the fiat currency and go long the asset. Volatile, yes. Again, I'm not promoting this, but this is the strategy they're carrying out. And they're the best performing stock. So do you want to be the best performing investor? Short the fiat currency, go long the asset. Make sure that you can handle volatility in the price and then wait for the outperformance. This is the strategy. They're carrying it out in real time. They are accumulating BTC. They're going short the fiat currency, long the asset. And obviously the way that they're doing it is people are buying in, they have the cash there, they're buying the asset's going up in price over time, and they're literally demonetizing the fiat currency. So it's very clever. I can't promote this or recommend this, but this is the strategy, right? Short the fiat currency, go long the asset. Now I'll come on to trading more actively in cycles, which is what we all want to do and make extra returns. I think for beginners, just be consistent, buy great assets and wait. For people that are more advanced or trading, you want to take advantage of these cycles because they exist, and over short periods of time you can trade them to make excess returns that you recycle back into assets or just take the profits out to spend it on things that you need. So we know that the global money supply, contraction and expansion, has cycles. This is the rate of growth year over year. So we can see you have bull markets and bear markets, bull markets and bear markets, and the price of Bitcoin follows that, and the price of risk assets follows that. So if we know they occur, we can take advantage of them. So what you can see is that as we have a bull market in M2 or money supply growth, Bitcoin has this bull market, and the bear market, it contracts. So what we're in right now is making this video. It seems like we're in a bull market, but the actual rate of growth isn't seemingly very, very toppy or overdone. Up here are the two times where money supply growth tops out, right? It's way overdone. It's too much. Market's getting way too hot. Central bank doesn't like that. It's going to draw things down, and it did do on these occasions. So right here, we're in a bull market. We're coming from the lows in money supply growth, which is good news. What is money supply growth? Credit creation from banks, central banks printing money or creating liquidity through their other means into the market. That pushes money supply growth up. We're in a bull market for that, but we are mid-stage and not topping out. That for me is good news. It means I can ride that trend up higher. So we look at Bitcoin. Now I trade Bitcoin, I invest in Bitcoin. You can look at other risk assets as well if you want. Bitcoin has the best data because it's all on chain. You can see this. These are drawdowns in bull markets for Bitcoin. So you can see that in a real bull market, the drawdown is usually 20 to 50%. In this bull market previously, it was around 30%. Here we've got around 30%, a little bit more for a couple of drawdowns in the previous bull market. So in a normal bull market, you're looking at anywhere from 20 to 40% drawdown from highs, and then you go again, drawdown from highs and go again into new all-time highs because the asset is growing and the money supply is pushing it higher over time. This is the rate of change, but as we've seen, the nominal amount of currency units just keeps going up. Even though the rate of change supplies and contracts, the nominal amount is going up. So it pushes all assets up, but they rise and fall along with that over time as well. And that's why you have bull and bear markets where prices go up and down, but generally the price level always rises. So I want to take advantage of this. We're in a bull market. The rate of money supply growth is rising over time with some volatility, but it's going up and it's not topping out. I know that the bull market drawdowns are 20 to 40%. So I can use that to trade. So I go to my trading system and I just simply take trades and go long when we draw down. When we draw down and when we consolidate, when we're 10% down from a high, I just go in. Here, whatever, trade and take advantage of those drawdowns in bull markets. And that is how I can try and outperform. Now, I'm doing two strategies here. One is dollar cost averaging, where I just buy great assets over time. I buy Bitcoin. I don't care about the price, goes up or down. I don't care. I'm just going to buy it. I'm going to wait and wait. I've done that already and I'll keep doing it. Now, the more advanced side of me wants to trade cycles as well, because I can trade and actually make excess returns in a small amount of my portfolio, which I will use the profits to take some money out to pay for things, and then most of it will go back, just recycling back into the assets to hold them for the long term. So if I can outperform, then I can do that. So how do I outperform? I personally use very, very low leverage in some trades. So I short the fiat currency, go long the asset. What I would do, or am doing now, is taking very low leverage on some trades. So I don't trade with anything more than 2x leverage. 2x leverage means if I put $1,000 down, I can open a trade worth $2,000. I've got $1,000 to pay for potential losses, which means that $2,000 trade can fall 50%, and that's when I get wiped out on the leverage that I'm taking. I've only got $1,000, I have a $2,000 trade. If the $2,000 trade moves down 50%, I get wiped out. I'm happy with that because the normal drawdown is around 20 to 40%. So that's pretty good. I also have assets in Bitcoin that I can use if the price does fall to fund that trade further. I have those assets there. Now, I just do this very low risk because I want to remain in the cycle. I want to remain active and I want to try and use my capital effectively. So I'm using a very small amount of my portfolio to fund some very low leverage trades. And I just use that as a small amount. And even if the whole thing goes to zero that I'm trading, it doesn't affect me. But that is how I will outperform in a cycle, is that this price movement, right? This price movement here of a few 100%, right? On a small amount of my portfolio, if I'm using 2x leverage, that move is doubled. The risk is that I get drawn down on as well, but I can fund that down to literally, I can fund 100% of that trade if I want to. Just move some of my Bitcoin into that trade. I'm never going to get stopped out. It's impossible. But I'm just using a small amount to basically outperform the cycle, to make some extra returns. And if I get called, I'll just put the assets in there to pay for it. People get caught out when they use leverage that is way too high, 10x leverage, 15x leverage. You're going to get stopped out. You're going to get liquidated. And what's the point of that? I'm in for the long game and I'm just shorting the fiat currency where I can and going long the asset where I can. That's the game I'm in, and I'm going to make sure that I do that and never get caught out, never lose your coins. But that is a strategy where I can actually make excess returns. Look, I don't need to make more than this, right? The asset is up 300% in 12, 16 months, something like that. And a small amount of leverage on that is enough, right? It's actually enough. And that's the 1,000% that you're going to make in a cycle. So that's how I do it. Very low leverage, don't get stopped out. I can pay for everything, very small amount, but the vast majority is just in the asset and getting that rate of return over time. That's for more active traders and people that have been in the market for a long time. I do not suggest that beginners use leverage in any way, shape, or form. I think you have to be in the asset class, stocks or Bitcoin or whatever else for at least 8 to 12 years before you actually start using any leverage and figuring out what it is. Look, I'll leave the Crypto Investor course link down below if you want to get 300 videos on setting up your portfolio perfectly. I'll leave deposit bonus links to the exchanges I use if you do buy crypto and Bitcoin, all down in the description, and all the other resources I'll link down there as well. I'm James, it's MoneyZG. Cheers for watching, and I'll see you in the next one.